Really looking at 1/1 renewals, I mean, reinsurance pricing globally across most product lines weakened at 1/1. I think there's really a couple exceptions out there, but for the most part, rates were down. I mean, when you look at the closely tracked property capacity market and what happened out there, there's plenty of capacity. There's plenty of capacity to meet customer demand. But at the right price, programs were sometimes oversubscribed. There were some lower layers that had a little bit more difficult time getting over the line. But I still think, the final offered rate had to be reasonable to achieve that outcome. So rates were down, risk adjusted rate. It depends on what you look at. We looked at it probably down 5 to 10%, really in those upper layers. So property, I think for the most part was still fair and reasonable in those renewals. So we felt pretty good about how that turned out. Casualty, particularly US casualty, it's a different story. Reinsurers for the most part are largely a quota share market. And so, our fortunes really are tied to the clients in terms of original rate increases. Because of the tremendous amount of adverse development, once again, that we've touched on from 14 to 19, and frankly, 20 to 22, we have a little concern about that as well. They're not looking great. So, because of this, for us, companies are getting meaningful double-digit rate increases. They have to. And if you have a U.S. casualty portfolio and you're getting 8 to 10% rate, primary price increases, I mean, you're really not in the game. You're falling behind. You're not keeping up with trend. So we're really looking at markets that are keeping, their head down, working hard, pushing rate 15 to 20. And those are the markets I think that will be able to pull through this kind of bump in the road that you were seeing in casualty, which is probably bigger than a bump in the road. It's a pretty big speed bump. But two other lines to talk about really for us in North America that were large renewal cycles, it's the D&O and cyber. D&O, we're in the fourth year of a soft market, and there's really no signs yet of anything turning in that market. So it's quite disappointing and depressing at the same time. I look at cyber, and despite the fact that there's probably more ransomware incidents that took place this last year, maybe at an all-time high, and a couple of near misses, if you think about it, with regards to some systemic potential issues. I don't know, reinsurers are paying more ceding commissions. The market is softening, the rates are down. We don't get it. It's a difficult market.